Hello and welcome back to Almus Market Mornings, your daily dose of global financial update. And this is Shikhar Garg, your host. The momentous FOMC decision was out yesterday, a 75 basis point hike. The largest hike since almost 2 decades was seen. The shrinking of bond portfolio continues, which would also be stepped up to $95 billion in September by the Fed. Now, these are the kind of updates we've received from the FOMC yesterday. But the eventful week does not end here. We still have a lot of events coming up. The BOE meeting, the BOJ meeting, Eurozone CPI. So there's still a lot more to come for the markets. But what has all these updates ensured is quite good volatility in almost all segments of the market. But in USD INR, it seems that the central bank is managing the volatility in the currency quite well. So JK, what do you think? What's happening? I'd like to have your update over here.
Yeah, good morning, Shikhar. I think it looks like a long week for us this time, and been waiting ever since the CPI was announced last week. We've been looking forward to the Fed rate decision. In fact, it was debatable whether Fed's rate hike of 0.75 is a hawkish move or a dovish hike. While he did clarify that 0.75 is not given for the future meetings, dot plots indicate rates have to move by another 1.75% by the end of 2022. Rate hike in 2023 will be a modest 40 basis points, but the market reaction certainly indicates that they don't think Fed is getting any more hawkish than discounted ahead of the event. That explains why all the market segments, be it bonds, stocks, or currencies, recovered modestly. We would even call it profit taking because markets had moved substantially already. 2-year yield had already moved by 3.45%, rising more than 70 basis points after the CPI data. And that is precisely where the dot plot projects end 2022 rate to be. Stocks had tanked by 10%, and DXY had rallied by 3.5%. From 102.30 to 105.70, a new 20-year high. In our view, these moves were excessive in short term and fully discounted the move by Fed, and hence the retracement is completely justified. As for the economic forecast, GDP growth estimates are cut to 2.8, cut from 2.8 to 1.7% for 2022, from 2.2 to 1.7 in 2023, and from 2 to 1.9 in 2024. So that's cut down in growth forecast, and unemployment rate is now seen higher at 3.7% in 2022 versus 3.5%. Core PCE deflator is seen at 4.3% from 4.1%. So effectively, it is a picture that Fed is giving that higher inflation and lower growth, and that's not sounding good for the investors. In the presser, he played up the significance of the rise of University of Michigan consumer inflation expectations reading published last Friday, which lifted to 3.3% from 3%. Also noted the importance of headline inflation from an expectation perspective, notwithstanding that they look at core PCE numbers from an expectation perspective. So while Fed has hiked 0.75%, the biggest question haunting us is whether they are going to achieve a soft landing or not. It certainly depends on how long the inflation will remain high. If they are forced to keep hiking rates, even as the price situation does not improve, the economy is going to see a severe slowdown. And with Ukraine war and the resultant enhanced pressure on supply chain issues at play, a prolonged hit to economic activity seems to be on the cards. This will see stocks continue to underperform along with bonds, while dollar will continue to attract buyers due to higher yield attraction. The ECB meeting, of course, aroused a lot of curiosity, but it ended with Governing Council being charged with coming up with new anti-fragmentation instrument, and in the meantime availing themselves of the existing PEPP to skew away its reinvestment, the proceeds of bonds maturing. Basically, this is an interim step which is aimed at saving the peripheral economy's bond market. And in fact, yesterday we did see tightening of the spread between Germany and Italy as well as Greece after the decision and after the Fed meeting also, it stayed that way. The other interest is surrounding Bank of England, which is set to raise interest rate for the fifth time since December, its steepest run of rate hikes in 25 years. Again, you see the other each of the other major central banks are in various different positions. Like I said, ECB is going slow, but their rate hikes. Bank of England is going steadily. This is the fifth consecutive hike, but they are hiking into a severely slowing down economy. So a stagflation in UK is given, and it's not surprising that currency tested 2-year low at 1.1932, although it has bounced on short covering. Bank of Japan is in a totally different zone. They're still looking to contain deflation and waiting for inflation to hit 2% target consistently. And until that is done, they pledge to continue unlimited bond buying program. And when they meet on Friday, they're most likely to reiterate this policy. While they are expressing concern about the current extraordinary weakness in the yen, their easing policy will not help them in curbing the same. Level of 135 plus is so far holding up, but without a strong action through either policy or direct intervention, the latter being more likely, yen is unlikely to reverse course from its weakness. So the dollar retracement looks like a correction so far, and neither technically nor fundamentally a reversal is seen in any of the currency pairs. Of course, we did have sharper correction in Chinese yuan because the data from China yesterday was quite good on the industrial production and retail sales. So we expect some more correction in the dollar. But again, as I said earlier, we are not seeing any change in the direction for the dollar as well. Yes, as far as the rupee is concerned, it becomes a sideshow now with the central bank calling all the shots, and any attempt by the market to take the USD INR higher is completely thwarted by them. And we've been hearing hefty amounts being sold by them above 78 levels, and that's actually a dampener for anyone who tries to bid up the dollar based on the fundamentals. We really do not know the agenda of the central bank, except that they are trying to curb inflation through keeping the dollar rupee steady. And but how far will it go? Particularly when you look at the trade data yesterday, it came at 24 billion plus, and this was a slightly upward revision to the initial estimates of 23 odd billion per month. So where are we headed in terms of current account? Definitely much more deficit than earlier expected, and possibly into a BOP deficit as well. Are we hoping for big investments from foreign investors to return? That looks doubtful as well, because the financing conditions globally is very tight. So does it mean that one fine day we're going to have a big fall in the rupee? Again, these are questions that we can only seek from the central bank to answer. So we'll keep ourselves in that suspense and make do with the 10 paisa move that we get intraday in the dollar rupee, because that is our bread and butter. Yeah, have a good day. Thank you.
Okay, wonderful, JK. And indeed, it was a long week. There was so much of data, but also a lot of movement in all the segments. But I'd like to re-highlight or reiterate what JK just mentioned. The trade deficit was 24 billion plus for India, and there are likelihoods of even a BOP deficit. Now, these kind of macros does sound bearish for the rupee, USD INR to go higher, and that makes us question the kind of role the central bank is playing. At the same time, I see a lot of action by the ECB as well. The surprise meet that the ECB took on the anti-fragmentation decision, and the action that they're doing to save the peripheral economies. But I also see a different or a mixed world altogether, because here a lot of nations are fighting inflation, while Japan on the other hand is waiting for the inflation to come to 2% target itself. So all in all, quite a mixed world that we are into, and a lot of actions in the financial markets. Hope you guys are managing your risk. Till then, we take goodbye. Thank you. Join us again tomorrow.